Hello and welcome. My name is Thorsten Tiet. I'm the founder of Dividend Stocks Cash Stocks here to make long-term profit growth visible to help you benefit from growing dividends and capital gains as well. For investors, Starbucks for a long time till now is a very successful investment. Here you see the capital gains till 15 years back, and you see that it's always green. I'm also invested in Starbucks. I bought my shares about 1 year ago. So my capital gains are close to here 35%. From time to time I look what happened, what the company did, and what I've seen about Starbucks did not make me very happy. That's also why I decided to make a soft sell of my 200 shares. I will explain later what this means, but first, even more important, why I'm not that happy. First, let's have a look at Starbucks from a fundamental perspective, and first long-term profit growth, which can be seen here. It looks quite nice. Also growing dividends as well, bolstered by growing revenues and in the long run increasing operating margins as well. That's all solid, that's all pretty nice, and that's why Starbucks is a successful investment so far. We also see the operating cash flow, and here we see that the operating cash flow peaked. That's an upfront payment from Nestle. They made a partnership with Starbucks to sell Starbucks coffee, and that's all pretty solid, that's all pretty nice. What's not so nice is visible in the full chart analysis. And let's change the layout first. And here we see the balance sheet, the evolution of the balance sheet, at least the most important aspects, including the total debts, total liabilities. And what's interesting are the latest three balance sheets. This is the last full business year, 2018, 2017. That's the current state of affairs, and here we see that from 2017 to 2018 the balance sheet increased, both liabilities and assets. So you might already ask yourself what happened here, and then we see something even more interesting. We see that the total liabilities remained about the same, but that the total assets shrinked considerably. Especially the cash and short-term investments became much less than before. They diminished from about 9 billion to just above 2.1 billion, so about 7 billion less. So we really need to see what happened here, because the balance sheet looks much worse here than it looked just at the end of the last business year. First, what's about this increase? And Stock Screener cannot tell you these details. It can show you that something happened like here, but to get the real idea, or to get a real solid answer what happened in detail, we have to look at in the annual report or the quarterly report. Let's have a look first at the annual report 2018, where the business year 2018 is compared to the business year 2017. And here we are. And here we see for the total liabilities, 8.9 in 2017 compared to 22.9 in 2018. That's exactly the figures we see here, 22.9 2018 and 8.9 in 2017. And then we see here that there's deferred revenue of 6.8 billion, and that's the upfront payments of Nestle, which are valid, or which span for several business years. That's why they are deferred. It's already an explanation for the increasing liabilities, at least partly. But then we also see that long-term debt increased about 5 billion, and our long-term liabilities about 750 billion as well, including total current liabilities. They also increased for more than 1 billion. This means that Starbucks made additional debts, so they issued notes, and for these notes they pay, I was looking at this already, between 2 and 4.5% interest rates. So we see we already got the explanation here why the balance sheet nearly doubled. We see that there was payment about 6 billion and the rest was total debts. So that's why the total liabilities increased. And we see here the cash also increased. That's also the payments of Nestlé and the result of the additional debts. And now comes the most interesting part, which is why did the assets decrease? And to get an idea about this, we have to look here in the last quarterly report. It shows the evolution of the last 6 months, which is exactly the change or the delta between here and the last business year. And let's have a look at this. And then we see first that we have total liabilities. They about remained the same. And then we go to the consolidated cash flow statement, and then we see something very interesting. We see repurchase of common stock, and Starbucks already makes share repurchases for a longer time already. For example, in the comparison period, they repurchased shares for 3.2 billion, and there in 2018 they bought back, I made a note about this, about 58.5 billion shares with for an average price of $53. And the current stock price is here at an historic high, about $77 right now. And Starbucks accelerated their share repurchase program. You can see it here. From 3.2 billion, we have share repurchases of 7.8 billion. In other words, they use the additional debts and all the money they got from Nestlé to accelerate their share repurchase. And the average price of the share repurchase I was reading was $72 per share, which is quite expensive right now. And they retire the shares. That means there's no treasury stock. They really retire the shares, so the shares are literally destroyed. This leads to a deficit in equity. At the end of the last business year, equity was still 1.2 billion, and now it's minus 5 billion. And that's exactly what we can see here. You can't see the negative equity here, but you can see that the cash diminished from about 9 billion to 2.1 billion due to the share repurchases. And the result is a weakened balance sheet and also higher stock price, because the increasing stock price is at least partly due to the accelerated share repurchase program. And that's something I don't like, because I ask myself if this is really a sustainable investment strategy to buy back your shares to increase the stock price. And on the other hand, you have investments, for example, in China, and we have political tensions in China. And China is the future growth market, and there is, due to the political tensions, a question mark, at least in my point of view. On the other hand, in the United States, where most of the business is done, we have a more or less a saturated market. And this is a combination, I think, which is not very healthy. And then we need to take a look at the valuation of the company, and then you see that we have current price earnings which are higher than Microsoft, just to give you an idea. And this is not a correct combination too. And this made me sell a covered call for 2 contracts for my 200 stocks in the money. Strike is 75. The current price of the stock is 77.53. With the prime, or thanks to the prime, I get a little bit, my setting price is a little bit better than compared to the immediate sell. It's not a sell recommendation overall. So if you're a long-term investor and you're happy with Starbucks, keep the stock. I just wanted to give you my opinion about what happened here, but with the accelerated share repurchase program, which at least in my point of view led to a weaker balance sheet. And then we also have this China investment after Starbucks bought the joint venture. So at least in my point of view, it's a combination I didn't like so much. So I gave my shares for sell using these two optional contracts. That was Thorsten from Dividend Stocks Cash. Thanks for watching. See you next time. Bye bye.